Risk trends have retreated in a week that has been supplanting scheduled data with broader concerns around deficits, but sentiment doesn't look ready to collapse just yet. While AI and Middle East relation concerns are still lurking, the markets seem to be focusing their concentration on this slower moving threat. I'm John Kicklighter, Senior Strategist and Global Head of Content for StoneX, here to discuss market conditions, themes, and top scheduled event risk that global traders and investors are likely to be focusing on in the week ahead. Now, starting with the general market conditions, I do believe that we are still in a longer-term risk-on lean, but we certainly had a little bit of a pullback in sentiment through this past week. Now, this isn't enough to flip trends, although you could look at certain benchmarks like high-yield fixed income and see that it has been already trending in this direction. But that inconsistency is kind of bulldozed through by the broader confidence that we have in benchmark assets like U.S. equity indices and global equity indices. And to turn that sentiment is probably going to take quite a bit. Now, this sentiment is probably overriding the general focus on themes. So we do have still a lot of thematic interest out there that could be headline or scheduled event risk, headline being things like the U.S Iran conflict, or event risk like the upcoming Jackson Hole Symposium. But we are still seeing that the markets, with a general buoyancy in terms of sentiment, are going to filter through that incoming headline or news and put it through that filter. This can significantly curb the impact of major events that would otherwise surprise in normal conditions, and it can amplify beneficial consideration, although not much in the way of tractions for momentum, whether it be risk on and certainly not risk off. But if we look at the backdrop conditions, we've been talking about this for the past few weeks, and I will be talking about it for the next few weeks because it is a very consistent situation. We can see that the S&P 500's August performance has edged back a little bit. We're just above 2% for the month, and that falls much more in line with the moderated performance that we expect in this month, especially when it comes to the volume. Volume is generally restricted in this month. This is the nadir of the calendar year when it comes to averaging out. And I don't think that necessarily changes unless something really dramatic and systemic factors in the markets, and more likely than not, that would be a risk-off event. But for the time being, these market conditions are still holding. However, we are still seeing some adjustment in some of the themes that fall just under the threshold of just broader risk on, risk off. And one of those is actually a transition into a anti-fiat consideration or a focus on the dollar's prominence as a safe haven, which is a theme that certainly has risk on, risk off connotations, but it's shifting underneath that big picture threshold. But in terms of the general market approach that I'm taking through the coming week, I'm going to focus much more on both breakout and range. Of course, I think that we have to be more wary of volatility. Volatility can come around, but I don't necessarily think it takes traction. But that means that that volatility that is more prevalent is likely to make more of the range boundaries suspect. So the likelihood of a breakout, but again, not necessarily coming with follow-through. So preference is to look for short-term breakouts with not much in the way of follow-through. Range is likely to be restricted, but still within a timely construct. It would be interesting. Trends are the ones that I'm going to stay away from until the week of September 7th, because that will get us to that transition period historically when markets will transition out of the absolute bottom of the summer doldrums into more active fall trading conditions. And as for the markets to watch, I am certainly shifting my focus on the dollar, but also in that context, it's Treasury yields and all those derivatives that are representative of Treasuries, U.S. Treasuries, TLT, TN, ZB, the futures markets, because there is a absolute focus on this theme now, and a lot of volatility, which we have seen prominently spike this past week, and obviously that has implications for the dollar, but also the dollar in context of anti-fiat, not necessarily dollar-euro, you watch that, but I'm looking at dollar and gold, or Bitcoin, both those old hat and new hat anti-fiat benchmarks have seen a surge this past week, and that's likely because of the anti-dollar sentiment that is coming with the Treasury's pivot in buying bonds. Now, I'll also be watching the traditional benchmarks for risk trends like the S&P 500 around the 7,600 level, but I'll also be watching the Dow and DAX and other major benchmarks along those lines just to get the cadence and the bearing of risk trends. Now, in terms of the themes that we need to be mindful of going forward, I think that yes, we are focusing on AI. It's still on the cusp. It's on the outer rim of our interests. If Anthropic files for an IPO, then it will come roaring back to interest. And of course, you can't take your eyes off of the U.S. Iran situation. The sentiment around that does not seem to be good whatsoever, but it's still not garnering greater traction in broader sentiment beyond lifting, obviously, the energy complex. But in its place is the deficit in the United States, but the deficit globally. There are growing threats to the amount of debt that is being taken in the public space, but also the private space. When we look at AI infrastructure investment, taking a lot of the interest away from traditional government debt, which is being used to facilitate exceptional spending, so fiscal stimulus. This is a leverage issue. So it's a leverage issue that we've already seen and we talked about in previous weeks in the capital markets, but it's shifting over also into the public. And these are the foundations of issues that we've seen that really catalyze and cascade into much deeper market corrections. Not necessarily that this has to happen, but you recall housing in 2008 or speculative leverage in the internet age back in 2001 or in the Asian markets and debt. Government debt in the 1998 Asia financial crisis. These are the types of backdrops that can cause major problems, but it's a slow mover and markets have a great capacity to just ignore it until it becomes a situation in which they cannot. So keeping that in mind. In terms of the traditional themes that we'll be looking, I think that they're looking at over the calendar, it's a high risk, meaning we can very much move away from the headlines and focus on the actual event risk that's on tap. But we will have to see it in the context of what themes currently matter. And I would say that deficits and debts, obviously, but that also has transmission into monetary policy, inflation, and there is quite a bit on that kind of tenor. As for top event risk, we're looking through a week that is going to be more backdated and certainly in the themes, as I suggested. Monday is relatively light. I will be watching the U.S. National Activity Index from Chicago Fed, as well as some U.S. short-dated debt auctions, 3-month and 6-month. Things are probably going to be more important as the markets are really looking to see how much capacity there is to purchase this debt, especially with these growing deficit burdens. On Tuesday, that's when China's MPC Standing Committee begins, and they will be tapping into themes like economic activity, financial health, and it can give us some useful insight into this otherwise difficult to read country, the second largest in the world. This will run until Friday. Usually they announce things at the end of the run, so perhaps mark that on the calendar for a Friday. I'll also be watching sentiment through this session. On Tuesday, there's going to be a lot of sentiment from consumer and business, German business, South Korean, Brazilian, France consumer confidence, but I will be watching particularly the U.S. Conference Board's consumer confidence report after the U of M figure had actually dropped back in its recent update, and that's going to be really an engine of growth, the U.S. consumer representing a disproportionate influence globally in terms of driving forward economic activity. Wednesday, we have a lot of inflation figures. We have Australian CPI and US PCE, the Fed's favorite inflation indicator, or it was before Kevin Warsh. No knowledge now if that is his preferred. But in the US session, we're going to get durable goods, the second quarter's corporate profit figures, and I'll also be watching the EIA oil inventory figures, certainly watching that amongst the US Iran conflict. And we also have the sale of a 2-year fixed rate note and 5-year standard note. Again, watching those debt auctions. And then after hours, I think equity traders are going to be watching that Nvidia release. That's the top market cap company in the world. And it also has AI implications. So we want to see what that does to, let's say, QQQs after hours. Thursday, Chinese industrial production, we have the Bank of Japan buying its debt, JGBs. Of course, we have to watch in Japan as well. It's struggling with its debt and deficit and its devalued currency. Eurozone lending figures, Mexican trade balance, U.S. trade balance, and Canada's current account. And that's also when the Jackson Hole Symposium will begin, but we're only going to get some intro remarks. We really want to wait until Friday. Friday is when we're going to get Kevin Warsh's official statement from the Jackson Hole Symposium and really steer what the focus is for his monitoring and captaining of the central bank. And that will come around 10 local time, Eastern Standard Time. But aside from that, we'll also have Japanese employment, Japanese CPI. We're going to have earnings from China, PetroChina. There's going to be a lot of it. Also, the four major banks on Saturday. Eurozone sentiment, consumer confidence, inflation expectations, going to be a big one for the ECB, which will follow. Canada GDP, and we're going to get a NFP's annual revision, which will draw a lot of scrutiny as it has in recent months. And as for the week ahead, we're also going to be looking at emerging market GDP, Turkey, India, Brazil. We're going to also have Australia GDP, Japanese capital expenditures, Eurozone inflation. We're going to have the Bank of Canada and RBNZ rate decisions, Broadcom earnings, ISM figures, and non-farm payrolls. So a lot on the week after, but I don't necessarily think it's going to be a anticipatory week this week, meaning we're going to stunt our impact this week just to facilitate what the expectations are next week. We can certainly move with volatility this week. All right, that wraps up the week ahead. Don't forget to like and subscribe for more financial market insights like these.